Welcome to the XFO Intelligence podcast, Complex Q series. In this episode, we're diving deep into beyond the balance sheet, elevating non-financial threats into investment committee mandates. We'll explore the pressing risk perception paradox and how investment committees can revamp their governance architectures to handle undermanaged threats like geopolitical exposure, cybersecurity, and personal security. By the end, you'll understand the critical fiduciary shifts and operational mechanisms needed to transform risk oversight. First, let's unpack the anatomy of the paradox. Financial risks, with their neat metrics, like VAR, beta, and IRR, get the lion's share of attention, while non-financial risks often fall through the cracks. Why? Quantifiability bias drives committees toward what's easy to measure. Legacy charter structures and siloed authority fragment oversight, and incentive misalignment puts growth metrics ahead of resilience. Next, we confront the fiduciary imperative. Regulations now demand top-level oversight of cyber risks like never before. Geopolitical realities force stress testing, and personal security is a boardroom concern. Markets are now pricing resilience. Firms that don't elevate these exposures face higher costs of capital and increasing portfolio drag. So, how do we integrate non-financial risks into decision-making? 3 architectures. First, the Converged Risk and Investment Committee unifies allocation and risk oversight through subpanels that hold binding deferral power. Second, the Risk-Adjusted Return Integration Model prices risks into deal economics, like adjusting discount rates for geopolitical premiums. Third, the 3-Horizon Governance Framework calibrates oversight across strategic, tactical, and operational timeframes. Concrete mechanisms make this real. Charters must grant gate authority linked to non-financial thresholds. Unified decision scorecards should weave risks directly into hurdle rate calculations. Compensation must partly rest on risk-adjusted outcomes. And appointing a chief risk and resilience officer gives non-financial threats a champion. Proportional oversight prevents unnecessary bureaucracy, while keeping capital flow fast and responsive. Measuring what matters is key. Metrics like the threshold gate ratio, information conductivity, and the risk-adjusted IRR spread ensure committees track resilience gains in real time. In conclusion, shifting from return optimization to resilience compounding is the path forward. Governance is pathway routing for capital. Non-financial threats, when integrated, become decision-shaping components. Elevating these exposures into investment oversight is not an upgrade. It's fiduciary evolution. If you enjoyed today's discussion, remember to like, share, and subscribe to the XFO Intelligence podcast channel. We'd love to hear from you. Send your feedback to xfointelligence@gmail.com. Thanks for joining us, and until next time.